If you want an income on your capital, at the moment you'll lose 2% per year on cash. That's because inflation's about 2%, interest rates are roughly zero, so in real terms you'll make a loss. So if you want to invest in funds, that's one way to increase the value of your capital. But of course you have to take a risk to do that, so we're going to do a survey of exchange traded funds. We'll look at the income, we'll look at the expense ratio, which is the amount you pay the fund manager to manage your money every year, and we'll also look at the risk you take in the form of volatility for each of those funds. I hope you find this interesting. So what's wrong with cash? The average interest rate for a cash account in the UK is 0.8% per year. Inflation's 2%. That means that your real income is minus 1.2%. It's negative, which means the buying power of your cash is being eroded by inflation over time, and cash is not a great investment at this time. So I've looked at the fund universe using an application called ShareScope. The reason why I've chosen exchange traded funds is that they're very easy to buy and sell. They're very liquid. I've selected funds which trade in sterling because I'm British. I've constrained based on the size of the fund. NAV is the net asset value of the fund, and I've set a minimum of £700 million. I've chosen larger funds because they're more efficient, and due to investor interest, they're much less likely to close. And the reason why we're doing this is to look at income. So I only consider funds where the 12-month yield, that's the price of the fund, divided by the income, is greater than 0.6%. What I'm looking for is something which will beat inflation. The Bank of England has said that inflation will peak at 2.7% next year. So that's what we're looking to beat. Once we take away the fees, we have to beat inflation. These 4 and 5 letter codes are the 60 funds which were the result of that filtering process. They're shaded according to their risk. The funds which are very volatile over the last 12 months are in deep red, and the least risky funds are very pale. Risk is on the x-axis, so the most risky funds are on the right, and the least risky funds are on the left. And the income is on the y-axis. So high income is at the top, and low income is at the bottom. Ideally, we'd like a fund which has low risk and high income. In other words, it's in the top left of this plot. And I've circled the funds which look interesting. What this doesn't tell you is the cost of those funds. So that's what we look at in this plot. We still have income on the y-axis, but now instead of risk, we have the expense ratio on the x-axis, with high fees on the right and low fees on the left. And again, we want to be in the top left. We want funds which have low fees and high income. Unfortunately, there are very few funds which combine all three: high income, low fees, and low risk. Here I've sorted all of the funds according to their risk. That's their volatility over the last 12 months. And I've shown what's inside each of the funds. And you can see certain groups emerging. So property funds are the most risky. They occur at the top of the list. Then we have emerging market equities. So this would be shares in countries such as Russia, Brazil, China. And we can also buy the emerging market bonds issued by those countries. The EM bond funds are slightly less risky than the EM equity funds. Then we come to the developed market equity funds. So this would be shares in large companies such as Apple, Microsoft, or Exxon. Then we have junk bonds or high yield bonds which offer a very high income. For an income investor, they're very interesting. The two largest regional markets for high yield bonds are in the United States and Europe. Then we have inflation-linked bonds, which are government bonds linked to the value of the cost of living. And the two least risky asset types are investment-grade corporate bonds and government bonds in developed markets. And in particular, the largest markets and the safest markets are the US Treasury market, which loans to the US government, but also the German government bond market and the UK Treasury market. So you have to do your homework. Look inside the fund. See exactly which risks you're taking. Are you taking an emerging market risk? Is there a currency risk? If a UK investor buys a US Treasury and sterling strengthens against the dollar, they'll lose money. Your choice will depend on two things. Firstly, your risk appetite, but also your top-down thematic view. We've drawn up a 2017 investment map which lists those important themes. We'd love to send you a copy. Please email us at PensionCraft.com and we'll send it to you. Tell us which income funds you like. Are there some we've missed? You can tweet us at PensionCraft, leave a comment on our Facebook page, or take a look at our website for our library of videos. That's it from us. Have a great day.